Hey everybody, it's Bob and Phil with another podcast from Trade Genius. Ask me why I'm wearing this stupid thing on my forehead. I'll be right back.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. So Bob, why are you wearing an L on your forehead?
Have you ever seen the MTV music video from Smash Mouth?
Yeah.
Yeah, well, that's unless you're a banker, this is who you are. I am representing you, the American public. We are a bunch of losers. And Phil, I want you to show people what they're doing to us. I mean, not only do they screw you when things are great, but they get to double screw you when things are bad. And we're going to walk you through that process right now.
Yeah, so this is a chart of basically what this is telling you is that the Federal Reserve every single day pays the big banks. Remember we talked about the G-SIBs, the big eight, pays these guys $750 million in interest every single day on their reserves. And if you remember yesterday's video, we talked about how the reverse repos are climbing up, and it's kind of weird because the market's going up too, but one of those two is going to be wrong, and I'm usually not the banks, so the market's probably going to fall off here because they're not putting money in the market. They're putting money at the Federal Reserve. And this is why they're making huge interest. We're making north of 4% interest. Meanwhile, they're only paying 0.01% interest to interest bearing accounts, checkings and savings. So there's this big discrepancy. They're making a lot of money. But Bob, as most people may or may not know, that money comes from somewhere and it's not out of thin air, and the Fed's not making money. So can you kind of explain how this actually ends up being, well, I guess another bailout?
So look, it started with the pandemic response where they actually created money out of thin air and gave it to the banks and then asked the banks to not lend it out and to put it back to the Federal Reserve. So you got a situation where they created the dollars, handed it to the banks, and then told the banks, don't lend this money out, put it back onto deposit with us, and then we'll pay you not to lend so that we can liquefy you. Well, that's all well and good if the Federal Reserve was making money and sharing it back with, the Treasury of the United States. But the Federal Reserve is broke right now. I think it's down 1.6 trillion unrealized losses now. So that means any money that is being made by the banks is going right through the Fed, right into our Treasury, and is sucking out. Now, you could just do quick math here, guys. You could take $750 million, okay, and multiply it by 365 days. That's how much the Treasury is supporting the banks to not lend money to you. But it gets even worse, Phil. So you want to show them the next chart?
Here's the next chart, and this is more assimilation going on. So, we're laying out kind of like what's going on here, right? And you guys got to be paying attention. So you have all what Bob said. Ultimately, we're going to be footing the bill again. This is just a roundabout way to bail out the banks again because Fed's running at a negative, Yellen's out of money. When the margin or the debt ceiling gets raised, they're going to fight. It's probably going to create some chaos in the markets, but it's going to get raised. It always does. It will get raised. Yellen's going to issue a bunch of debt. Who pays for the debt? You do, the taxpayer. Who pays the interest on that? You do, the taxpayer. So all of this is just one big circle back into the pockets of the banks, ultimately. So what they're doing is they're concentrating the power in the big banks. And we know this because look at the deposit difference from the small banks. Boom, negative 100 billion. Boom, large banks. This isn't a coincidence. This is blatantly obvious that they're sucking the smaller regional banks dry and forcing all of the money, the deposits going into the big banks. You as a depositor or the average depositor is going to say, forget these regional banks. They sound super shaky. I'm going to go bank with the big boys. I mean, on the surface, that makes logical sense. You'd rather have the safety and the backing of the globally strategically important banks, right? The G-SIBs. So this is by design. And it's by design, right, Bob? Because what have they been doing for 100 years? We used to have 31,000 banks in this country. We're down to 4,200.
Yeah, and look, central planners only want to deal with the fewest amount of entities as possible because they don't want to work that hard. Mm-hmm. And plus, the more decentralized the banking system is, the harder it is to control. And this has a political component to it as well. If you could concentrate all the power into New York, right, the banking central of the United States, well, it makes those politicians very rich and very powerful and very, very influential. And the only people that get to run for Congress or Senate has to get funded through the banks, through these senators and Congress people, and they're going to handpick their people. And so it becomes a situation where basically totalitarianism is coming from a separate direction as well. And so it's a problem. And then also, as these small banks lose their depositors, they're going to get relief from the Fed, but they got to turn right around and put that money right back with the Fed. And so it's going to dry up lending across the entire United States. And somebody else said it besides me, said bankers, regional and local bankers, they do more things on a handshake than an algorithm. Big banks work strictly off of algorithms, okay? And so you're not going to have any personal touch. You're in Omaha and you want to get a loan and the banker's in New York and they're going to say, well, you don't meet our criteria. Hey, I want to talk to somebody. You can't talk to somebody. Press 2, for your toaster. And, that's how it's going to go. And it's going to be a big problem. In the meantime, not only are they doing that to you, is that you have to keep your money somewhere because it has to be liquid for your business. And the next chart you're going to show is showing just how and why this banking crisis started in the first place, basically the differential between depositors and savers at the banks. Phil, do you want to throw that chart up?
Yeah, so this is where we don't want you to get double suckered. All right, it's bad enough we all gotta through the mechanism of the Fed buying treasuries and all that stuff, and we're on the hook for the treasuries, right, for paying the interest on those things. All the while, the Fed is handing these banks money. They're not handing you money, they're handing banks money. However, you can get in on the better interest rate. If you're in a checking account or if you're in a savings account, and I'm talking the traditional kind, the kind you've been in for the last 10 years or longer, however long you've been banking at your bank, the line down here at the bottom, that yellow and that dark black line, that is the national average interest rate on checking accounts, percentage interest rate, and the national average for savings accounts. You're down there making practically zero. Okay, the green line is what the banks are making when they're parking it at the overnight repo. However, you can make over 4% too if you get into a money market fund. So I think they have money market checking accounts too, Bob. You just have to check. There's a lot of different products out there, but the point of the matter is you want to get into a money market fund. These used to be a little more popular in the 90s, late 90s, before interest rates started going to zero, and you could get basically a savings account over 4%. We're back to those days. If you're not doing that here, you're getting double suckered. Okay, not only are you going to be on the hook for the taxes we pay that go back to funding this whole scam, you're not making any of it back. And you need to be protecting yourself. I mean, if they're going to be making the money and handing it out to the banks, then you might as well be getting it too, right? So get into the money market accounts, whether it's a money market checking or money market savings. But if you got savings just sitting there and you're waiting, maybe buy a property, waiting for the market to drop, for goodness sake, stick it in a money market account. Because if you're not, you're getting double fleeced. And that's the one thing. If you take anything from this video, it's take that away and start making some of this interest rate. And a lot of people don't realize that that's what's going on, or that they can even do that, or don't understand what a money market account is. And so we're here telling you, go look for them because they're out there. Most banks, I've been getting mailings about them, so there's a lot of offers out there. Go on the internet and look. You can, one of these online banking services, you'll find money market accounts that you transfer money over. And the more you transfer, usually the more the interest are willing to offer you. But there's no reason to be making 0.05% interest anymore at these banks. You're just getting fleeced, and we don't want to see you go through that.
Yeah, look, if you want to be really lazy, just go ahead and put your money at Schwab, and they have a checking account. You could sweep it to a money market account. You could sweep it into a Fed Treasury bill, or you could sweep it into a dividend-paying stock. And it's all right there. It's an overnight action, and that's what I do. I mean, I have a business account, I have personal account, and I have Schwab and TD Ameritrade accounts, and I'm sweeping all the time. I keep only what I think I need to have in my checking account to pay the bills. But Schwab, I also have a checking account with Schwab too if I need it, and I'm with the USAA as well, and they offer a bank component too. So, and there's a lot of ways in which you can do it, but it's no longer time to be lazy with your money. If you need that money, even if you need it in 6 weeks, you can sweep it in and sweep it out 24 hours. But remember, the more you sweep out of the checking account, you're giving the banks less money to screw you on your taxes because they have less money they're going to receive as reserves, because now they're a custodian for you instead of you being an unsecured deposit depositor of theirs. Very important distinction. Do not give them free money. I mean, what a great deal. It's just amazing to me. I always tell Phil all the time, we're idiots. We should be banks. And how banks go out of business, to me, blows me away. Because these guys are leveraging. I had dinner last night explaining, in fact, they're probably listening to the podcast tonight. And I was explaining, basically the multiplier effect of fractional reserve lending, Phil, is that you can have the most secure collateral in the world and just lend to that. And you'll make a fortune because you're only putting up 10% of the money.
Right.
It's just insane.
Yep.
Absolutely insane how these banks manage to lose money. It's pure greed.
It is.
It's the closest thing you have to a Rube Goldberg machine.
Yeah.
But these guys tend to blow up every 10 years. I don't get it.
Yeah, and it's laziness too. That's what got Silicon Valley Bank. They had all this tail risk out there, and they were just like, it's like, we'll hold it to maturity. It'll be okay. Well, that's like poker and getting your bluff called. And so banking is a very cushy industry, especially when you're making a lot of money, and they just get lazy, complacent, and greedy. And the combination of that's very deadly. Deadly in banking, deadly in trading, deadly in life. So,
Except that when you try to treat the patient infects you.
Yeah. Yep. And then ultimately it comes back to privatizing the profits and publicizing the losses. And I feel like that's what's happening now with the way that the Fed's treating these banks and jacking up the reverse. There wasn't always a reverse repo window. That's a recent phenomenon. So it's another mechanism to bail out the banks. And that's, you guys have to realize this is like another bank bailout. It's like a proxy bailout or a shadow banking bailout, essentially. And I challenge anyone to argue differently. I'm open to suggestions, but I don't see that. I see it as another way to get these guys more money off the back of the taxpayers.
Yeah, and they do it because they don't need a congressional mandate. They don't have to all these sloppy hearings because it's one of those things behind the scenes where, we just increased the deficit. You know what I'm saying?
Right.
And the banks get monetized. And, here's the other thing, too. So Phil was arguing, I think, very effectively because we're like, why is this market not basically collapsing with these deflationary moves? Is because the Fed just went ahead and stuck all that money in short term. You're not paying the loan shark yet. So you got this initial pop in liquidity here, but these banks are going to drain it now with paying interest to the Fed. And so, we're going to go from this nice pop where everything's going to be good again. We talked about this yesterday. And then the deflation is going to wash through the system as these banks, they simply can't pay. All it was is a life preserver, but the boat left you. It didn't pick you up. You're still floating in the ocean. And so it's just a matter of time for these banks belly up.
And let's show them one last thing before we go. What Bob's talking about here, this is the liquidity bump that happened from the Fed. They expanded the balance sheet, and there was a big argument about, whether or not that was going to find its way in the market. Well, guess what? Found its way into the market. If you're thinking we weren't saying that market could go up, well, people in the newsletter knew that we were saying 40.95 was a big magnet up there for the last couple of weeks. And once again, the fair value in the markets got down to a level this is our liquidity indicator, which is coming out very, very soon. But these levels we're highlighting here was basically saying, hey, look, until we see otherwise, what the Fed did is going to boost this market. So now that we're out of the quarter end, month end, obviously this is a new regime going forward here. And you can already see the liquidity's coming back down. And we know the Fed has gone back to reducing their balance sheet. So it's like this little emergency operation. We're expecting to see this come all the way back off. And this will probably give us a signal like the last 5-6 times here that we're rolling back over. So bigger picture, that hasn't really changed. But, this is the kind of stuff you can get on the newsletter. We're not always bearish. Short term, there's a lot of bullishness that can be taken advantage. And we do during the week and during the day and stuff like that. But I just wanted to point that out. But what Bob was saying is that this is why, they said, they're backstopping the banks. Nah, this liquidity always finds its way into the markets. It's just the way it is. But short-term pop here and probably things are going to get back to normal because at the end of the day, the Fed's very clear. They want unemployment up. They want asset prices down. And this is going to continue to decline. It's just they're dealing with some speed bumps in the way.
Yeah, and let me be clear too. We're bearish macro, okay? But we're definitely opportunistically trading. I wouldn't tell you that I have 40 or 50 stocks long if I thought the stock market was going to zero. What I'm telling you is that it's what you need to own to survive and to thrive in this environment. And so you just have to be well informed here. And, there'll be a time for that when you want to be in total cash. But what I've been always telling people is a great rotation is coming. We're going to leave fake and go to real, and that'll be a theme that you'll hear from us as we continue to talk about this. But yeah, look, Phil, that macro that liquidity is rolling down, and as soon as Yellen needs to start filling her coffers, that blue shaded area is going to dump hard.
It will. And that's right after the debt ceiling gets raised. And that's another thing that's going to confuse a lot of the retail customers is they're going to think, oh, debt ceiling's raised, right? Bullish. That's awesome for the economy. But her getting her debt ceiling is going to actually drive this available liquidity down without getting super complicated. That's just the relationship it has with the market. So she's out of money basically here. She's got less than 200 billion, which for the treasury account is nothing. That's just nothing. And so she's very close to on fumes here. So the effects of her, she's been largely, if you guys have been following us, those that have been getting the newsletter understand that for the last 6 months, if you pull back on this market, it's been relatively flat across the board. Largely it was because Yellen's been drawing down her treasury account the whole time. That's what's really the only difference. It wasn't the Fed because the Fed was tightening. It wasn't the banks because the banks on net were kind of growing the reverse repo. And now you can see even more so now they're doing that. So they're not in play. The banks aren't in play now. They're hiding out the Fed, getting free money off your back. The Fed's rolling off their balance sheet, which makes less liquidity for the system. And Yellen's basically at a point where she can't drive down her account anymore. So this is why this thing's rolling back over. This is why fair value shooting back up is going to quickly get into short and sell mode here. If this keeps continuing to go up, we kind of think that we're probably going to get some pullback and consolidation down to 4,000, and we'll see how the week develops. What, Bob, seasonally April's bullish, but we're kind of in uncharted territory here.
Yeah, I mean, look, if it was a normal year, we would have rolled out of bearish bets here actually today and would have been preparing for a bullish 6 weeks. And one thing too we failed to mention yesterday, the last 5 quarters at the end of the first quarter, at the end of the quarter, were always red days. Okay, so obviously something has changed here, probably because a lot of this liquidity coming in, Phil. But yeah, typically April into middle of May is bullish. But, they front ran a lot of the earnings reports this first quarter. They've given a lot of these companies a pass.
Yep.
And so they're going to have some, harder comps this time. Cash flows leaving the building. Companies aren't getting financing. And so I think it's going to be a little bit more problematic than just a slam dunk, just buy in April and go away. I think it's going to be interesting. And plus, I think there's another Fed meeting in April. We'll probably see another quarter point for sure. If stock market's above fair value, he's raising it a quarter point.
Yep.
Okay, without a doubt. And now, Yellen has been against Powell. So if you notice, the market has really gone nowhere from September to now.
Yep.
And so now Yellen's neutral, Phil, and Powell's tight. And probably I would say that we're going to have this fight probably through May, maybe into June with the debt thing.
Yep.
And then Powell and Yellen are going to be in the same side of the liquidity train. They're both going to be sucking liquidity, which is money out of the system. At the same time, prices for cost of capital is high. So it's going to be a problem. And if the debt thing doesn't get resolved, that's going to be its own set of problems because you're going to see massive layoffs. And this political environment, I think, what they're doing to Trump in New York is probably poisoned the well a little bit. There's going to be very little goodwill between the political parties going into this fight. And so, you know what, I'm going to save that to Monday. We don't normally talk politics here, but I'll talk politics in the sense of how it's going to affect us economically, because I think there's a plan that's probably going to get enacted. And I think I'll talk about that on Monday next week. Sure. Because it's really, really important. I think it's going to happen. And I think it's going to also be another liquidity dump on the economy.
100% agree. Yeah. It's getting spicy, guys. So stay tuned because things I think are going to be changing quickly as we progress now, as we get closer to that debt ceiling issue. And it's going to be very, very volatile. So stick around. We'll walk you through it. All right. Well, that's going to do it for this video. Thanks a lot for watching. Please, please, please hit that like button. Subscribe if you haven't already. And also press the notification bell and set it to all if you can. That makes a big difference. Other than that, guys, have a great weekend and we'll see you on Monday. Take care.
Trade Genius.